So we are now going to start off with this question, the name of which is Columbia Company. Let's just see. It says Columbia is the parent of a listed group which operates within telecom sector. During the year ended 31st December 2005, Columbia acquired a new subsidiary and made adjustments to its pension scheme. The group's current year end is 31st December 2005. Following exhibits available on the left-hand side of the screen provide information relevant to the question. Acquisition of Peru Company contains information relating to acquisition and consideration paid for Peru Company. Then Peru Company's net assets. Then Columbia Company's pension scheme explains defined benefit and contribution schemes available to employees of Columbia. What exactly are the requirements of the question? The first requirement is draft an explanatory note to the directors of Columbia to address the following issue: whether Columbia should be considered as the acquirer in a business combination with Peru Company, a calculation of goodwill on 1st July 2005 explaining how fair values of both consideration and the net assets have been determined, and how the defined benefit and defined contribution scheme should be accounted for. Now see, let's talk about this acquisition of Peru Company. Let's discuss. It says Brazil Company is a competitor of Columbia Company. On 1st July 2005, both Brazil and Columbia acquired 50% of the 5 million ordinary shares of Peru. The consideration paid by Columbia consisted of cash of 8 per share and also a 1 for 20 share exchange. When the market price of Columbia's share was this, Brazil paid 8 per share for their interest but did not issue any shares to the original shareholders. The ordinary shares of Peru have 1 voting right each. Following the acquisition, Columbia had the contractual right to appoint 60% of the board of Peru Company, with the remaining 40% appointed by Brazil Company. Brazil Company has veto rights over any amendments to the articles of incorporation and also over the appointment of auditors. Brazil Company and Columbia each appointed 1 member to Peru's senior management team. It is the senior manager appointed by Columbia Company who makes the key decisions regarding the development of Peru Company. New technologies, its principal revenue stream, the markets that it will operate now, and how it is financed. The senior manager appointed by Columbia also provides a supervisory role and has the right to request the significant activities, get board approval, such as imposing restrictions on Peru Company from undertaking activities that would significantly increase credit risk. Now, so there is a complex situation that is being created. I'll just explain to you. Let me read through one more exhibit. Okay, the net assets of Peru reported in individual financial statements at a carrying amount of this. However, on acquisition of Peru Company, the directors of Columbia discovered the following. On 1st January, Peru acquired 6 million, 6% bonds for 6 million in an unquoted company. Bond interest is paid at this rate due to premium on redemption. Effective rate was this. Peru has a business model to collect contractual cash flows and so on. Colombia holds similar unquoted assets but has a business model whereby they may either collect contractual cash flows, sell the assets. Bonds with similar risk profile for a smaller quoted company were trading at this, a discount of this. Now, one of the intangible assets of Peru companies at acquisition was a brand. The brand had a carrying amount of this. Colombia has a similar branded product and etc. Peru has several technical support contract and etc. Colombia has a policy of measuring the NCI at fair value. Colombia's pension scheme. So this is something that is about Colombia's pension scheme. Now, There's one thing which is confusing, and I just need to go through that thing just to see what is actually going to happen. Colombia had the contractual right to appoint 60% of the remaining interest of Peru. Now see. Okay. What is the requirement of the question? It's a 9-mark requirement which is asking whether Colombia should be considered an acquirer in a business combination or not. Now, what exactly are you going to do with respect to this requirement of the question? Now, let's just see, let's just talk about it. You would have to mention that in a business combination transaction, the acquirer is the entity which controls the acquiree. Control is the current ability to exercise power over an investee. Power is the ability to direct relevant activities. The relevant activities are those activities that have an impact on the entity's financial position and performance. In the case of Peru company, there are shares acquired by Colombia company and shares acquired by Brazil company. Although the holding of both is the same, but although the holding of the both is the same, but an evaluation is to be made that who has control over Peru. An evaluation is to be made that who has control over Peru. So if you talk about it, you would identify this thing that Brazil and Colombia each appointed one member to Peru's senior management. It is senior manager appointed by Colombia who makes the key decision regarding development of Peru's new technology, its principal revenue stream, etc., 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 etc. Now see, so based on above, all the relevant activities of Peru are being directed by the management personnel from Colombia, and hence Colombia has control over Peru. That is what you are going to do. Now let me know in case if anyone has got any questions on this. Let me know if there are any questions, or else I'll move forward. Yeah, I'm waiting to hear from you. Let me know in case if there is any question. Yeah, anyone, please? Any questions, please? Do you people get it? Yeah, because I've related it to it. I've related it. You can copy paste. I mean, normally I don't do it, but here it was all relevant that could be applied. Yeah, you can define in your own terms. That is perfectly fine. You can define in your own terms. This is perfectly fine. Yeah, it's a clue that Colombia has control because it is directing the relevant activities of Peru company, and the relevant activities are the revenue stream and etc. etc. So it is directing all this. Now, let's move on to the second requirement, a calculation of the goodwill, explaining how fair values of both the consideration and the net assets have been determined. Okay, so let's just go through the goodwill calculation. Let's just see if there is any relevant. Okay. For the consideration, what is it that you will do? Uh, number of shares acquired, number of shares acquired, number of shares issued, value of each share issued, cash paid for the acquisition, %50 into 5 million is the number of shares acquired. The consideration is 8 per share acquired. The number of shares issued is 1 for every 20 shares, equals to this divided by 20 multiplied by 1. The value of each share that has been provided is 10. Hence, the cost of investment will be what? 30 million. The cost of investment is 30 million. Now what next is there? It says, okay, it's done here. Now the net assets of Peru reported in the individual financial statements that are carrying amount of 32 million on 1st July 2005. Okay, this is cost of investment, the fair value of non-controlling interest, The cost of investment, the fair value of the non-controlling interest, fair value of net assets. Now let's talk about all of them. Cost of investment, fair value of NCI, fair value of net assets. The carrying amount of these net assets was 32 million. At 1st January 2005, Peru acquired 6 million 6% coupon bonds for 6 million in an unquoted company at par. Bond interest is paid annually, okay, on 31st December. Due to premium on the redemption, the effective rate was 8%, okay. Peru has a business model to collect contractual cash flows from the bond and therefore measures it at amortized cost, okay. Colombia holds similar unquoted assets but has a business model so and so, so and so, okay. The bonds with a similar risk profile for a similar quoted company were trading at 2 per bond on 1st July 2005. A discount of 30% is considered reasonable to reflect the difference in liquidity of the two types of bond. Okay. So the fair value adjustment of bonds is going to be incorporated. I'm just doing the working calculations here. One of the identifiable intangible assets of Peru at acquisition was a brand. The brand had a carrying amount of 4 million on 1st July 2005. Colombia has a similar branded product and is therefore planning to discontinue the trade of Peru's branded product with immediate effect. The future cash flows from Peru's product acquisition are therefore considered to be nil. If trade of the branded product were to be sold to a competitor, in order to continue the trade, it is estimated it could be sold for around 5 million. The cash flows are nil, but the market value is 5 million. Fair value adjustment of intangible is 5 minus 4. Peru has several technical support service contracts for which there were outstanding performance obligations included in contract liability. At this date is 2.8 balance in respect of these contracts. It's estimated these contracts will cost 1.7 million for Peru company and any other market participant to complete. A markup of 30% is considered reasonable for this type of product. So there is a contract liability of 2.8 million that is actually included. So that means the undelivered contract is 2.8 million. What is going to be the cost to be incurred out of it is going to be 1.7 million. Now, the Colombia has a policy of measuring the NCI at fair value. Should have to see that what will we do with respect to the revenue contract. Think about it. You are obliged to deliver the goods and the amount would have been received in advance, so you booked a liability at 2.8 million. Now, the obligation to deliver the goods would have a fair value of how much we would have to see. So the cost that you would be incurring would be what? Let's just try to see this. Adjustment to contract liability equals to okay, just wait a bit. 1.7 into 1.3 is 2.21. You have booked a liability of 2.8. Normally it would cost you 1.7 to actually deliver this. So that means if markup of 30% is reasonable, so what we should do is that we should bring about an adjustment to it, which is equal to 2.8 minus this 2.21. Hence 0.59 is the amount by which liability has to be reduced. For the fair value of the NCI, 5 million into 50% into what is the value of Peru company's share right now? We paid 8 per share for their interest but did not issue any shares. And Brazil also paid 8 per share. So the payment that Brazil has made is an indicator of the fair value. Fair value of the bond held by Peru company is what? Is equivalent to 6 million bonds. Each bond has a value of 2. The carrying amount of bond is what? The cost is $6 million. Effective interest at 8% for 6 months. Cash interest at 6% for 6 months. Because these bonds would have been carried at amortized cost, right? So effective interest is this into 8% into 6 upon 12. The cash interest is this into 6% into 6 upon 12. The amortization is going to be this minus this. Carrying amount at 1st July would be this plus this, 6.06. So fair value adjustment will be so the goodwill would be cost of investment plus fair value of NCI less this 10.47 million is what the goodwill is going to be. Now I am waiting for 2-3 minutes. Just let me know if people are getting the calculations. So that I can move forward then. You just let me know. The position of Brazil in the business combination is that they are NCI. Okay, what is confusing? Please let me know. Okay, I'll go over it. Is everyone okay with cost of investment? Is everyone okay with cost of investment? Okay, fair value of NCI, are you all okay? No. Okay, Charlester. Now, you see, you acquired 50%, Brazil acquired 50%. You got control, so that means Brazil is non-controlling interest. How much did Brazil pay? They paid $8 per share for cash. And how much did you pay? You paid $8 plus you paid a one share for every 20 share also. Now, why did you pay extra? Because you have paid premium. For what have you paid premium? You have paid premium because you are getting control. So that means the other person who has invested is a non-controlling interest. And the non-controlling interest is Brazil. So whatever price that Brazil has paid, that is the fair value of the NCI. Do you get it now? Yeah, do you get it now? Okay, good enough. Now let's move. Fair value, the carrying amount of fair value is okay. Now the fair value adjustment of the bond. Do you people get it? Do you people get it? Okay, you don't get it. Now see, the bond that you have invested in worth $6 million. There was an effective interest rate of 8% and there was a cash interest rate of 6% because coupon was 6%. The bonds were acquired on 1st of January 2005. So the effective interest was what? 6 multiplied by 8% multiplied by 6 upon 12. The cash interest was what? 6 into 6% into 6 upon 12. So there is actually an amortization. The difference between these two is amortization. The carrying amount becomes the opening cost plus the amortization gives you the carrying amount. And once you have the carrying amount, you compare it with the fair value of the bond. So you end up getting the fair value adjustment because a similar type of bond. Okay, now wait. That there is a bit of an error. There was a 30% adjustment also that needed to be done. Yeah, I have not incorporated 30% adjustment. I will incorporate 30% adjustment. So 1 minus 30%. That means the bonds have to be valued at 70%. So this is what you will get. Do you get it now? Okay, good enough. Okay, I got 30% because they say that a 30% is a reasonable adjustment, right? That's what they're saying. A discount of 30% is considered reasonable to reflect the difference in liquidity. So if the bond is illiquid, there is going to be a bit of an adjustment, and we have done that. good enough. Now, the requirement of a calculation of goodwill explaining how fair values of both consideration and the net assets have been determined. So now you got to explain everything that you have done here. I repeat, you got to explain everything that you have done here. What I will do for my ease is that I will copy it. So what is actually going to happen over here is that in order to calculate in order to calculate goodwill, the fair value of the consideration is the cash paid of $8 per acquired share and the fair value of each of the Columbia shares issued to the shareholders of Peru. The non-controlling interest represents the shares owned by Brazil company and they have been valued using the consideration paid by Brazil company. Furthermore, additionally, for the measurement of fair value of net assets, the following adjustments are made. The bonds, with respect to the bonds, what has actually happened is, with respect to the bonds, the carrying amount was established using amortized cost method and the fair value discounted by 30% was established. The difference between the carrying amount and the fair value is recorded as the difference between the carrying amount and the fair value is recorded as the fair value adjustment. Furthermore, with respect to for the intangible, although entity is not expected to generate any future cash flows from it, but if it is disposed of today, it will fetch $5 million, and hence there has to be an adjustment of $1 million to the fair value. A contract liability for the undelivered services is recognized based on the contract. However, at the time of acquisition, since all liabilities are required to be remeasured to fair value, therefore, since all liabilities are required to be remeasured to fair value, therefore, fair value of these, therefore, fair value of these of this liability is established using the cost and the prevalent markup and an adjustment to the liability is incorporated. All the relevant workings are reflected in the spreadsheet. So that is how you're going to answer it. The number of shares issued is 0.125. Okay, just wait a bit. Just wait a bit. Value of each share issued is this. Okay. Value of the total shares issued is this into this. Thank you, Amina, for identifying. Thank you for this. I'd made a mistake. Anyways, this is what it is going to be. This is the benefit that you get while using a spreadsheet. Yeah, normally we account for it using IFRS 15, but when applying the IFRS 3 business combination, you have to bypass the accounting for other standards unless and until permitted that you are allowed as an exception. So at the date of acquisition, you were required to apply the requirements of IFRS 3 business combination. Okay, I'll explain the contract liability part again. See, normally, if you would enter into such contract, 1.7 million is the cost, 30% is the normal markup. That means you would have a revenue of 2.21. So if you have not delivered these services, that means 2.21 of the revenue has not been earned. Whereas in the balance sheet, there is a 2.8 million unearned revenue. So the unearned revenue should be 2.21, not 2.8. So resultingly, we would reduce the liability by the remaining amount. Do you get it now? Do you get it now? Yeah, do you people get it now? Yeah, you have received 2.8 in advance. That's why there is a contract liability. Otherwise, there would have been no contract liability. Okay, let's move on to the third requirement, how the defined benefit schemes should be accounted for. Okay. Colombia has for many years operated a defined benefit pension scheme. At 1st January, fair value of a scheme was this and present value was this. The total present value of future refunds and reduction in future contribution was this, and this. The table provides details of the scheme for the year ended 31st December 2005 when there was a curtailment to the scheme. Discount rate on good quality corporate bond was this. The current service cost, the cash contributions, the benefits paid, scheme curtailment, payment to employees, etc. etc. At 31st, the fair value of pension scheme assets were estimated to be this, and the present value of the scheme liabilities were estimated to be this. The total of the present value of future refunds and reductions was this. Colombia intends all new employees to be offered a defined contribution rather than defined benefit scheme. Contribution of 0.5 million were paid into defined contribution scheme for new employees over the last 3 months of the year. Okay, now I'll do the easy part first. You would say the defined contribution scheme requires the entity to recognize expense equal to the contributions that it is liable to pay to the scheme as per the terms and conditions. Based on the available information, an expense of $0.3 million. Is this 0.3 million? Sorry, 0.5 million. Is required to be recognized in the, based on the available information, the expense of 0.5 million is required to be recognized in the income statement, during the current year. This is the accounting for defined contribution scheme. For the defined benefit plan, I'll do the working on the spreadsheet. Okay, let's just try to see things. Now, always remember that even if you have recognized a defined benefit asset at a lower amount because of asset ceiling, but still the workings for the pension plans, etc., would always be done on the basis of the actual figures. Defined benefit plan, opening defined benefit assets. The opening defined benefit assets are going to be what? 260. So the assets are always shown as negative because the liabilities are shown as positive in this working. The interest expense slash income at the rate of 5%. Why? Because discount rate of high quality corporate bond is 5%. Then there is this current service cost. Which is 30. The contributions into the scheme, which is gonna be 21. Benefits paid are to be ignored in this net liability approach. Curtailment. You had a 28 million of curtailment and for which you paid 16 million. So there is actually a gain on curtailment. How much is that going to be? -16 minus 28. Remeasurement gains slash losses. The gains are gonna be negative, losses are gonna be positive. Clothing defined benefit liability or asset. Gives you hence this is gonna be the balancing figure. So equals to this, equals to this minus the sum of so the remeasurement loss of 19 will arise. But do we need to recognize it? Let's just try to understand. Okay, now let's just see. The asset ceiling which operated at the start of the year, it was 20 million. And the asset ceiling right now is 25 million. That means the asset can only be recorded at 25. You cannot book an asset at 47. You can only book at 25. So the accounting journal that needs to be passed in the current situation, I am going to guide you about that. This is debited, this is credited. The defined benefit asset would be debited by 5 only. You would not be recognizing the defined benefit asset by a very huge amount. Now, interest income would be this. Okay. Current service cost would be this. Gain on curtailment will be this. The contributions paid will be normally it's a liability approach, right? The contributions paid actually are an outflow from the entity. The remeasurement gain slash loss to be recognized will be 1 million only. That's it. Nothing else. You would not be recognizing 39. You would only be recognizing 1. You would not be recognizing 19. There is only going to be 1 to be recognized. You would say why? Because let me guide you a bit. Your opening defined benefit asset were 60, but you had only recognized 20. Now closing defined benefit asset is 47. That means there is a reduction of 13 in the defined benefit asset. But you can recognize defined benefit asset to the extent of 15. Sorry, to the extent of 25. That means other way around, there is a movement of 5 that is actually taking place. So technically what happens is that there is a 13 reduction, but other way around, there is a 5 addition that you can book. And overall, the remeasurement gain loss is 19. So resultingly, this is termed as, this is combined 18 and this is 19. You see, previously, when you would have got a remeasurement gain or loss, you would have not been able to recognize it. Why? Because remeasurement gain or loss is always the balancing figure whenever asset ceiling applies. Remeasurement gain loss is always the balancing figure when the asset ceiling applies. So if the asset ceiling is applying over here, it's going to be the balancing figure, which is going to be recognized. Yeah, scheme curtailment of 28 means you are supposed to pay 28, but you ended up paying 16. So there is a gain of 12 in the P&L that needs to be recognized. No, we are not obliged to pay the remaining because the settlement has been done. The gain of 12 on the curtailment comes from 28 is the liability settled, but 28 is the liability extinguished, but only 16 has been paid. The asset ceiling restricts the extent to which the defined benefit asset can be recognized, that is 25 million, and hence based on all this remeasurement gain/loss will be the balancing figure, that is 1 million of the remeasurement loss to be recognized in OCI. That is how things are going to operate. That is how things are going to operate. We record entry from our perspective. It's outflow from us. It's outflow from us. It's outflow from our side. It's outflow from our side. So that's why we say contribution as an outflow as a credit entry. So do you get it now? Okay, guys. So we are done with this question also, the name of which was Columbia Company and one of the recent past examination questions.